Now, you have smallholder farmers comprising of men and women in Africa face a lot of challenges, one of which is access to finance at a cost that is reasonable for them to remain productive in the agricultural sector. Now, the high-level forum organized in Nairobi, Kenya by the African Development Bank Group was tailored to access the financing challenges of these millions of smallholder farmers who form a critical part of the agricultural value chain on the continent. And let's take excerpts from this panel heard earlier today.
DBC about this. I think the question that came up was, how did we put together a financing facility for immunization? And so let me take us back, if I may, very briefly to November 2003. And the question, I worked at Gavi at the time, the question on the table was, how did we scale up the availability of financing for purchasing vaccines at a time when things were very, very fragmented? I looked on the website of what was called the IFM before I came here to see how it's going. To date, it was a dream in 2003. We launched it in 2006. To date, before I got here, it's raised $9.7 billion, 42 bonds, 8 currencies, with multiple types of bonds. So dreams are possible. So just a couple of thoughts about what we did then. We were very clear about the problem we were trying to solve, and it was a lack of financing for what was then a pretty unclear market in terms of demand for vaccines. The design challenge, we really tried to solve a few things. How did we scale the financing and really make the cost of the financing efficient? How do we understand the risks of the capital stack that we put together? One thing that's very different from the IFM to the smallholder farmer challenge is that we were not financing the delivery of actual vaccines. We were financing the purchase of vaccines. So quite a different problem. But we were also very clear about the public policy challenge that we were trying to address, which was putting together a financing facility that borrowed at just a few basis points more than what the underlying borrowers were borrowing at. Was that worth it compared to being able to reach herd immunity faster? So we were very clear about those challenges.
The first is 14%. That's the yield that Kenyan government bonds offer and that the corporate banks are buying up. And 3%, that is the average return that banks across East Africa earn from their lending to agricultural SMEs. And so we need to bridge that gap if we want private capital to flow. In this case, and our focus as a CELI is on agricultural SMEs, and we focus there because they are aggregators, they provide market access for smallholder farmers, they create jobs along value chains. And so we set out in 2018, and I've spent about 20 years working in agricultural SME finance, and we wanted to understand this problem. And so we went around and asked banks for their data. How much do you earn from lending to agricultural SMEs? How much does it cost you? Your operating costs and not just risk. And that's where we landed on that 3%. And I think that much of this conversation around finance, whether it's focused on agricultural SMEs or smallholders, is focused on risk, which is important, but insufficient time is spent looking at cost, transaction costs. And particularly for agricultural businesses that are located several hours from urban areas where the bank branches are located, cost is a huge issue. And so we need to think about solutions that understand the full equation of profitability, including the cost of the transaction cost to go out and find and underwrite loans and monitor them, the cost of risk, and then the cost of capital that financial intermediaries, whether they're banks or others, incur. And so at CELI, we've been working for about 5 years. My colleague Richard facilitated a panel yesterday with our partners from Family Bank and an SME, SOPA Supplies here in Kenya, a food processor. And essentially, we're sharing in the risk, but also defraying the high transaction costs to get banks and other lenders to extend farther, to increase their risk appetite and serve agricultural SMEs. And then those incentives are complemented by capacity building. Capacity is a huge issue. I think the president just spoke about the knowledge that exists or lack thereof in many commercial banks. Right now, the status quo for a lot of lenders is a negative cycle. Agricultural lending is not profitable or not nearly as profitable as other alternatives. The treasury of those banks don't allocate capital internally. The senior leadership don't assign resources, so you have underdeveloped agricultural departments. So there isn't much knowledge around agriculture. There's a high perception of risk, and there's very little lending.
To talk to us about the Africa Guarantee Fund, please situate AGF in this conversation and discussion about the design of financing facilities, which seems to be one of the major sort of impediments to actually supporting smallholder farmers.
When we look at the numbers, so today the contribution of agriculture to the GDP in Africa is 30%. But when you look at the composition of the lending portfolio of the commercial bank, only 6% is allocated to agriculture. So only 6% for an output of 30%. So this is where the problem is, and this is what we are trying to solve. How can we increase this allocation from 6%, why not to 20 to 50%, so that the commercial bank can do more? And the reason why they're not doing so, also Mr. President mentioned it, risk. Risk is a critical factor. How do we de-risk? And when we want to de-risk, what are we de-risking? I think we need to understand how we got there. What are the real reasons the commercial bank are not comfortable with the risk coming from the agricultural sector? And we have many reasons. So one of the reasons is the lack of information. We talk about the small farmers. Most of them are in the informal sector. They are informal, meaning it's very difficult to be able to trace the information. They don't do proper bookkeeping. So when they go to the banks, they don't have enough information, and even the bank are not in a position to do a proper risk assessment to understand the type of risk that they are taking. So lack of information is a big challenge. Another challenge is the lack of collateral. We talk about the smallholder farmers. They represent 80% of farmers, but they own less than 5% of farmland, the smaller farmers. Meaning they're already in a difficult position when they go to the bank because they don't have any forms of collateral. And the preferred forms of collateral is land. So they're already also in a difficult position. So how do we solve the issue of the lack of collateral? Another challenge is the resource gap. We tend to say that our commercial bank, they are very liquid, but the bank that normally serve the smallholder farmers are cooperative. And when you look at the structure of their resources, it tend to be short-term resources. And those farmers, they need long-term investment, to acquire equipment, storage facility, the truck, the tractors. And those banks, they have most of their resources come from the depositors. So on one side, they have 6 months deposit, but they have to finance maybe a 5-year loan. How do we resolve this mismatch? And then lastly is the product. The product that most of the banks are offering is not aligned to the farming cycle. When we talk about the farming cycle, what the farmers, they do is that when they get the money, first thing, they prepare the soil, they buy the seed, they plant, they grow the crops, they harvest, and then they go to the market.